Welcome to XRP Pro Ledger, and today we need to address something directly before we get into the data, because what is happening right now on a Friday night, while most retail investors are stepping away from their screens, is not a coincidence. A leaked internal analyst note has surfaced from inside a major institutional desk, introducing a metric called the velocity of value, and the math it produces has reset the minimum structural price target for XRP from $3.42 to $3.65. At the same time, on-chain monitors have tracked 116 million XRP leaving centralized exchanges in a 48-hour window. 64% of all liquid XRP supply is now locked inside institutional-grade custody or smart contract vaults. Stay with this analysis until the end, because what is being engineered this weekend quietly, deliberately, and out of sight of retail is the final supply compression before a repricing event that most investors will only understand on Monday morning. Let us start with the psychology of what Friday night means in institutional markets, because this timing is not random. Retail investors have a well-documented behavioral pattern. They disengage from the market on Friday evenings. They step away from charts, stop monitoring on-chain data, and allow the weekend to function as a mental reset. Institutional desks know this. They have modeled it, studied it, and they rely on it. The hours between Friday's New York close and Sunday midnight represent the lowest retail surveillance window in any given weekly cycle. It is precisely during this window that large desks move their most sensitive limit orders into position, accumulate at compressed prices, and quietly close the remaining doors on open liquidity. What feels like a slow Friday night to a retail holder is, in reality, the most operationally active period of the institutional week. The data from tonight's New York close confirms this pattern with unusual precision. In the final trading hour before the weekend, institutional desks reported a significant uptick in XRP ETF block trades. These are not small retail purchases. Block trades are large, pre-negotiated transactions executed between institutional counterparties, the kind of activity that moves balance sheets, not individual portfolios. What makes tonight's data particularly significant is the positioning of limit orders. Wall Street desks have stacked heavy buy-side limit orders at the $1.38 support level. This is a deliberate technical construction, a floor designed to absorb any downward price pressure across the weekend and prevent volatility from disrupting the accumulation phase. The institutions are not watching the price move. They are engineering where the price will hold. Now let us address the $3.65 number directly, because this is the most important data point to come out of institutional research circles this week. Leaked internal analyst note, circulating in private wealth offices and senior desk channels, introduces a framework called the velocity of value. The model measures the relationship between XRP's transaction throughput speed and the liquidity depth required to settle institutional RLUSD volume without triggering slippage. As Ripple's RLUSD product scales to meet incoming institutional demand, the transaction velocity on the XRPL increases. And as that velocity increases, the minimum token price required to maintain settlement efficiency rises with it. The note's conclusion is direct. The new minimum structural price is $3.65. Below that number, the settlement math breaks down at institutional volume. This is not a price prediction. It is an engineering constraint. The $1.61 billion figure sitting in US spot XRP ETF AUM right now is the structural foundation that makes the $3.65 thesis credible to institutional risk managers. In previous XRP market cycles, there was no permanent Wall Street floor. The asset could correct deeply because there was no institutional cost basis anchoring the price from below. That structural reality no longer exists. $1.61 billion of institutional capital is now locked into US-registered spot ETF products. That capital does not panic sell on a Friday night. It does not respond to social media sentiment. It sits on balance sheets managed by portfolio risk teams with quarterly mandates, and it establishes a floor that simply could not have been engineered in any previous cycle. This is the fundamental change that separates the current market structure from everything that came before it. The 105% US Treasury collateralization rule is generating a financial mechanism that most analysts are still not pricing into their models. At Ripple's current RLUSD backing level, the collateralization structure is now producing a $4.20 million weekly interest surplus. That is not an annual figure, that is weekly. On an annualized basis, this mechanism generates over $218 million in yield from US Treasury instruments held as RLUSD backing. According to institutional sources familiar with the allocation strategy, This surplus is being deployed as liquidity incentives, essentially paying U.S. banking partners to migrate their settlement operations off SWIFT and onto the XRPL. The Federal Reserve's own rate environment is funding the displacement of the correspondent banking system. The irony of that construction is not lost on the desks that are already positioned for it. The 64% lockup figure requires direct and careful analysis because it represents a supply condition that has no historical precedent in the XRP market. When 64% of all liquid XRP, excluding Ripple's escrow holdings entirely, is confirmed inside institutional-grade custody or smart contract vault structures, the available float for open market transactions contracts to 36% of the circulating supply. That remaining 36% includes retail holdings, exchange liquidity, and market maker inventory. It does not include the tokens that institutions are still actively trying to source for their own balance sheet needs. The practical consequence of this supply structure is mechanical. When institutional demand channels attempt to absorb from a float this compressed, price discovery does not move gradually. It gaps, and the entities holding the remaining 36% are not the ones who will be setting the terms of that transaction. The 116 million token supply drain recorded over the last 48 hours provides the operational detail behind that 64% figure. On-chain monitors track 22.4 million XRP, leaving centralized exchanges in 3 distinct late-day batches, each routed to a Tier 1 custodian address cluster. These were not random wallet movements. The 3-batch structure spaced across the trading day is a standard institutional execution pattern designed to minimize market impact during the transfer process. The destination addresses have been identified by on-chain analytics firms as belonging to a Tier 1 bank custody infrastructure. Combined with the movements tracked from April 29 through today, the total 48-hour supply drain now exceeds 116 million tokens. Each of those tokens moved from an exchange order book into a custody vault where they will not be available for retail purchase at any price. The Washington D.C. development that arrived late tonight may be the most consequential piece of this entire picture. Sources leaking from inside the Senate Banking Committee are reporting that committee members have reached an informal agreement on the commodity language for bridge assets, specifically referencing XRP's classification as a digital commodity ahead of the May 15th session. This is not a formal vote. It is not a public announcement. It is the kind of back-channel alignment that happens before legislation moves with speed, when the disagreements have been quietly resolved and what remains is the procedural formality of the markup session. The institutions that have been building their positions over the last 2 weeks were not doing so on speculation. They were doing so on the same informal intelligence that is now beginning to surface publicly. David Schwartz's activity tonight adds a technical dimension to the institutional thesis that deserves careful attention. Following his earlier hints about programmable transaction privacy on the XRPL, Schwartz posted a cryptic technical diagram on a developer forum this evening. Analysts familiar with XRPL architecture have identified the diagram as a blueprint for what they are calling institutional sidechains, a technical architecture that would allow U.S. banks to leverage the full security and settlement infrastructure of the XRPL while maintaining complete privacy over their specific transaction data. This is the architecture that would allow a major U.S. bank to settle billions in daily transaction volume on the XRPL without disclosing counterparty details or transaction amounts to competitors or regulators beyond the required reporting obligations. When that capability is live, the NDA barrier that has kept institutional partnerships from going public dissolves. The final data point from tonight confirms that institutional capital is not waiting for the sidechain blueprint to be finalized before deploying. A new institutional-only DeFi vault with KYC requirements and minimum deposit thresholds designed specifically for private wealth office access absorbed $18 million in XRP deposits in under 3 hours tonight. $18 million from private wealth offices moving through a product that retail participants cannot access in less than a single trading session. That velocity of capital deployment is the clearest possible signal of institutional conviction at the current price level. The entities making these deposits have done the risk modeling. They have reviewed the $3.65 velocity of value note. They understand the supply compression math, and they are moving before the weekend window closes. The picture assembled from tonight's data is not complicated when viewed through the correct analytical lens. The Senate has informally agreed on the commodity language. The velocity of value metric has established $3.65 as the new engineering constraint. 64% of liquid supply is already locked. 116 million tokens were removed from the open market in 48 hours. The $1.61 billion ETF floor is permanent, and Wall Street desks are stacking limit orders at $1.38 to hold the price stable while the remaining accumulation completes. The retail investor who steps away this weekend because the chart looks quiet is making the same mistake that retail has made at every major inflection point in institutional adoption history. The quiet is not boredom. The quiet is the sound of every remaining liquidity door being closed one block trade at a time. If this analysis changed how you're thinking about XRP, hit like and subscribe. I drop deep dive breakdowns like this twice a day to keep you ahead of the market.